This is the definitive guide to the price of uranium and uranium's supply and demand dynamics. This is not investment advice. Please regard this as for entertainment purposes only. Now, before we take a look at the most recent price developments in uranium, I'm first going to have a look at the longer term picture, going back to when the uranium industry really began. And in the 60s and 70s, uranium was the new best thing. Everyone over the world was building nuclear reactors, and there was a lot of uranium also being used for nuclear arms race. And in the 70s, we had this pronounced bubble. The green line here is accounting for inflation, and the blue line is nominal numbers. But we had this massive spike in the uranium price in the 70s. However, this led to a massive oversupply of uranium mining. And then, as the popularity of nuclear power declined following the 3 Mile Island incident in 1979, this bubble burst and uranium entered a 20-year bear market. This was made worse by the megatons to megawatts program, where after the fall of the Soviet Union, lots of Russian nuclear warheads were downblended to form nuclear fuel. And we had a situation at the turn of the century where most of the mines had all closed down or gone bankrupt following a excess of supply for many years. However, then we got a situation of undersupply. All of the loose uranium that was floating about had all been mopped up, and then this led to a price spike in the early noughties, which ended it with the 2007 bubble. This was exaggerated by a number of major mines in Canada flooding. However, this was a very short, sharp spike, and what followed on from there was another 20-year bear market. So this brings us to the last 5 years. And in 2020, all of the remaining mines had were actually all shuttered up, and inevitably this led to an increase in the price of uranium. Now, I should explain that we have two prices for uranium. One is the spot price, which is the light blue line, and that price is actually uranium contracts for delivery within a year. And then you have long-term uranium price, which is the dark blue line, and that's where contracts are signed for delivery normally a number of years in the future, and that's often supplied directly from the mines to the utilities. Since 2020, the long-term price has more than doubled to $75, and the spot price followed it along, but then there was this massive spike in the spot price in 2024, but it's been going down ever since and is currently quite a bit below the long-term price. Now, there's an interesting observation here, which is that in a bear market, the spot price tends to drag below the long-term price. And actually, what happens then is utilities stop buying long-term contracts because they know that whatever uranium they need, they can just buy off the spot market at a cheaper price. And so that leads to this dynamic that we saw before of the spot price dragging the long-term price lower. And then when we're in a bull market, the spot price tends to stay with or lead the long-term price. And it's obviously a little bit concerning that at the moment it does appear here that we're in a repeat of this kind of situation here. And in this video, I'm going to be looking at all of the parts of the nuclear supply cycle to try and understand the behavior of the spot price versus the long-term price over the last few years. I get this data off the Cameco website. The long-term price only gets reported on a monthly basis. The spot price is reported daily. However, it's hidden behind paywalls, However, I found that if you go onto the Yellowcake website, they're actually reporting it on a daily basis, the data being supplied by Numerico. So I've been using that resource to plot the spot price. And as we can see, we are in this worrying situation here with the spot price now quite significantly falling below the long-term price. Now, back in 2020, there was one dynamic that I thought was bullish for uranium, and that was that at this time the spot price was only about $30, and that meant that actually only 40% of the mines in the world would be able to mine at a profit at that price. At the current spot price of $65, practically all of the mines in the world can now mine at a profit. So here's one big factor which explained why the price of uranium should have gone up back in 2020, but which is no longer in existence as a bull case for uranium. Another thing before I go into the details here is you get these overarching supply and demand images portrayed all over the place, and these more simplistic diagrams, and these do provide a good basic kind of measure on supply and demand. And I've got three sources here. This one's an old one, which is one that I was using myself a number of years ago, and this comes from the World Nuclear Association. And here you can quite clearly see that although back in 2020, yep, there was definitely a shortfall of supply versus demand. From this year onwards, for about the next 5 years, there appears to be a good match between supply and demand. The prospective mines are the ones in purple here, and that's not that much actually of the totals here, with the yellows being idled mines that are restarted. And so here, really, there really does look like a match between supply and demand for the next 5 years. Here I have a more up-to-date source. This is from the Yellowcake website, and they've got this data from Mindspans. The brown line up here, that's their high demand case, where the green line here is the base case. But if you were to say draw a line halfway between those two, again, we kind of definitely have a bit of an oversupply over the next 5 years. Whereas back in the 2020 time period, which was when I was first interested in uranium, there was definitely a shortage. And here's the same data, but from a third source, in this case, the Curzon Uranium website. And again, here, we do seem to see that we have perhaps a match between supply and demand over the next 5 years. In fact, you could argue here that actually it's an oversupply over the next certainly 2 years. And so, for all the complicated arguments that you hear being shouted around, when you look at this basic data from three different sources, you have to accept that yes, there was an undersupply since 2020, and that's why the price went up. But over the next 5 years, really, it looks like there's certainly a match between supply and demand, with the real shortfalls not being until the 2030s and onwards. Here's the overall supply and demand dynamics for uranium. And of course, first of all, the uranium is mined. Now, the utilities, they tend to pre-order their uranium they're going to need 2 or 3 years in advance on contracts that normally span about 5 years. So these contracts are signed in advance, and that explains this, and that's the term market. That's the long-term price that you see here. But so this volume here, that's the term market volume. It's not the amount shipped in a particular year to meet demand. It's actually the amount ordered in a particular year for long-term future contracts. The actual amount being delivered every year is a great unknown. I've looked everywhere. There is one data point on that number from the World Nuclear Association, and that dates to 2022, where they make this claim of how much was shipped in that year. But of course, that's just one data point that perhaps, as with lots of things with uranium, you just get one odd data point here or there. All of the mill bloggers and analysts, they're kind of often all referring to the same one data point for different things. And who's checked that? How can I check that to know the calculations? And can we trust a lot of the data all the time? But still, there is one data point which I have on this graph here, as that indicated by that purple arrow. But other than that, we don't really know what's being delivered from the miners on a yearly basis. The uranium that does get delivered, it's delivered as this yellow powder called yellow cake, which is triuranium octoxide. And then it goes through the conversion and enrichment process to create the nuclear fuel bundles to be used in the nuclear reactors. Now, the triuranium octoxide, this has a uranium-235 isotope concentration of 0.7%. That gets converted into uranium hexafluoride gas. This is actually a gas. That then gets shipped to the enrichment plants, where it gets put into centrifuges and enriched to uranium hexafluoride with a U-235 isotope concentration of 4.6% typically, although that can vary. And this then is deconverted back into a solid form of uranium and then fabricated into the fuel rods. Now, a concept that's going to come up later is when you do this centrifugation to form this enriched uranium, you also get what are called tail assays, which is the other uranium that the heavier isotopes been separated from, and this will have a low tail assay, or basically a lower concentration of the U-235 isotope, which, as you can see in this typical example, is 0.3%, and that's obviously lower than even natural uranium is. And this is actually how you get depleted uranium, which is used for tank rounds and things like this. It can also, in some circumstances, be recycled, which I'll go into later. But anyway, that explains the conversion and enrichment steps. So I've supplemented this diagram with this one, where you can actually compare what is the size of the conversion capacity with the enrichment capacity and how that stacks up against reactor demand. Now, you get something called secondary supply, which I'll detail in a bit. So the reactor demand is met not just from the yellow cake that's being produced by the mines, but it's been topped up as well by secondary supply sources. And in the background, there's civil and government stockpiles, which again, although these can be a demand or supply source for the term market, the spot market, or mining production, they're also a way which, if there's a shortfall, the utilities can tap off this resource as well, affecting the demand from mining production. And then we have the spot market, which has kind of lots of traders dipping in and out. But generally, the spot market is used by miners. So some miners who haven't got the right contacts and stuff, or enough scale, they will dump material onto the spot market, and utilities will every year top up any emergency requirements from the spot market if they're not met from the other means. And then finally, we have the ETF demand. There are a couple of ETFs in existence, and they dip in and out as of the spot market and the overall mining production themselves. So here's where I've got the data to create these graphs. So if anyone wants to check them and let me know of any mistakes in the comments, please do so. I will point out that one data point here is I got from a YouTube video I saw given by Lucijan Valkovic, and that's the only source of information I could get that data point from. So, but please be aware, I'm kind of awaiting confirmation for that. But otherwise, you've got all the sources here for all the data. And so I'll begin with mining production. So in this map, you see what's the net production or requirement of uranium from all over the world. And we very quickly see that the biggest demander of uranium really is the US and Europe, with China, though, standing out as well. And the biggest supplier of uranium is Kazakhstan. You can see that in this pie chart down here, with Kazakhstan, Canada, and Namibia being the main suppliers. Now we can clearly see that overall, actually, the production from mining is increasing exactly as these graphs were saying they were going to. And unfortunately, though, we get the overall numbers fairly easy, but it's kind of hard to track for most miners around the world what they are actually producing. The main exception being for Cameco and Kazatomprom, where because they're both public companies. And in this chart, I've got the world total production of all miners. Then the dashed line here is production from Cameco plus Kazatomprom, and also Kazatomprom's mining partners. And the solid line here, that's the actual sales or the amount actually shipped in a given year. There's a further breakdown here, which are indexed down here. But the important trend really is that Cameco, Kazatomprom are trying to kind of rig the market. They have been trying to keep prices down by not selling much. You can see the price is, you can see that the amount that they've actually shipped has remained fairly constant. They've been fairly disciplined. However, the actual amount of mining going on is increasing. And then when we look at the total world production, we see that although Cameco and Kazatomprom are being fairly disciplined, it's questionable whether the other miners in the world are being disciplined. So we see that Cameco and Kazatomprom are trying to respond to prices and rig the market to some extent. But overall in the world, the mining production is increasing. And so that's definitely like a variable here we need to take account of. The grey box here, that's inventories for Cameco and Kazatomprom. You see it's actually fairly stable. In a raging bull market, you'd kind of expect it to dip down to a small amount. And on the other side, if we saw this starting to increase because they were kind of holding back some of their supply, that would actually be quite bearish. But as it is, it's been fairly neutral. But this is a good thing to keep an eye on in the future. Okay, so ETF demand, we can see that in 2021 and 2022, Sprott and Yellowcake, they actually did take quite a lot of uranium off the market. And I can remember back in those years, a lot of pundits were raging about, how this was going to really put a rocket on the uranium price. But as it turns out, for the last 2 years, they've stopped buying. And so the ETF demand story was basically just a big nothing burger in the end. Even if I think it is fair to say that I think those Sprott purchasers contributed to these two bulges in the spot price that we had at the same period of time. But lately, the ETFs are nowhere to be seen. And actually, there was a third ETF called ANU, and they bought £2 million in 2022, but last year they actually liquidated the company, and those £2 million got dumped on the spot market. So onto the spot market, which we've seen had quite high volume in 2020 and 2021, but then that volume has thinned considerably. So the spot market volume represents all contracts for deliveries within a 1 year time period. As you can see, the spot market interacts with pretty much everyone, but the most important things are that the utilities do buy off the spot market every year, and some miners actually, if they haven't got enough production, will buy from the spot market to make up for that, as well as other miners actually dumping onto it. Now in here, I've got the amount of utilities direct buying from the spot market in blue. Then in red, where miners have bought from the spot market for their supply contracts. By the way, I don't have the data point for that for 2024, so I've just kept it the same. But given the known overall total, it's probably not far off that. But be aware of that one data point there is an unknown at the moment. In purple, this is the ETF buying that didn't last very long. And then grey is unknown spot market volume, which a lot of which will just be traders nipping in and out. So what's interesting is when uranium was last in a bear market, you can see that the spot market kind of led the term prices downwards. And what was actually happening during this period, because the spot market was so cheap, the utilities weren't doing long-term contracts off the miners. Instead, they were just gobbling up spot market volume at the lower prices. And so a symptom of a bear market in uranium is a bit like we see in 2020, where a lot of the spot market volume is actually utilities buying or miners buying to cover up supplies. The miners were deliberately holding back on production, but then topping up their contracts, topping up their deliveries with spot material. And then in 2022 and 2023, we see more what's indicative of a healthy spot market where there isn't actually very much utilities and miners buying, because the supply chain kind of working how it should do, with most of the supply coming from long-term contracts from miners. And you'll notice how the spot market volume was higher in these bad years, but then went lower as the uranium price went up, whereas the term market volume started low and then went up. And so this was because back in 2020, 2021, the miners were using spot market material to top up the supplies they'd promised. And so that's why the term market volume was low. Whereas now, as you can see here, it's kind of more normally functioning, with most of the supply coming from the term market, with spot market material being a much smaller proportion. Now, in this chart, supply sources and demand sources matched up. And you can see it quite well here, because this black line is the term market volume. So that's this graph here, plus secondary supply, because you've got to consider that as well, stacked up against reactor demand and ETF demand. And you can see that process here when we had the kind of unhealthy market at the end of the bear market, with the spot price leading the term price down. Here you can see that there wasn't actually much term market volume, because as you see here, the miners were actually using spot purchases to make up the difference, as were the utilities. Whereas here you see the supply and demand a lot more tighter. You can see here how the spot purchases have completely dried up compared with in the bad old days. So overall, actually the spot market as of 2024 does look really quite healthy. However, I'd like to see this data point here to kind of confirm that, how much of this grey is miner purchasing. And given how the spot price has been crashing at the end of 2024 and coming into 2025, I think this would be a real key thing to watch for 2025, to see if we get a return to these bad habits of buying off the spot market. So the term market, I've already explained how we've seen increased volume on the term market. We got to remember that the term market volume is for deliveries in several years in the future, not for deliveries the same year. And I see a lot of these future coverage charts doing the rounds, and this is often presented to kind of shock potential investors into thinking, oh no, we're going to run out of uranium in the future. Well, the first thing is actually the Europeans are clearly oversupplied is the first thing. But the second thing is that for the US, I wanted to investigate if this shock tactic passed through a test of a bit of simple mathematics. So what I did is I actually tabulated that US data, and I assumed, well, what if the utilities covered 100% of a yearly demand spread over the next 5 years, based on this as the initial data point. I then asked the question, well, what would their coverage look like 5 years from now? Is there a impending shortfall, as you're being kind of scared into thinking when you see these slides? What I found was actually the profile stays the same. So actually, in reality, the US is fairly well covered as long as it meets its current demand every year in the future. It's fairly well covered. Also, we're fairly sure that Russia and China have well in excess of what their needs are, as well as the EU. Only the US seems to be okay supplied, let's say. And the US is only really like a quarter of the overall demand anyway. Now, in terms of the term market demand, it was low in 2020 to 2021 because obviously the miners were underproducing and mopping up spot to meet their contracts. However, it's now kind of healthy at around 120 million pounds a year. Last in 2023, it was 160 million pounds, but that was because of a one-off amount of supply to Eastern Europe because of the Ukraine war. So it's been kind of healthy for 3 years. And so, you can definitely see a transition here from an unhealthy term market where they're using spot, where the spot market's being used to mop up uranium, to this healthy situation where the term market seems to be accounting for most of supply. So then we get the mysterious actual long-term deliveries each year. Like I said before, only one data point exists for the whole world, which is this purple triangle here, which actually strangely matches up with the term market's volume for that year, plus the secondary supply. But otherwise, this data is kind of a mystery worldwide, which is a shame because it would be great for helping us understand the uranium price. But we do have good data for the US and EU, and the term market deliveries were also kind of fairly steady, but jumped up a bit in 2023. But really, for the world as a whole, this is an incomplete picture for actual minor term deliveries in each year. So now to look at civil or government stockpiles, and what I've done is I've got a barrel here to represent the equivalent of 10 million pounds of yellow cake. Some of the stockpiles composed of uranium hexafluoride, enriched uranium products, or even the fabricated fuel bundles. But I've tried to refactor all the quantities into the equivalent of 10 million pounds of yellow cake represented with each barrel. Now, this is actually where I got the data from. I used the IAEA Global Inventories of Atomic Energy Supplies 2023 as the initial data source. but I found that there were errors in it because when I then looked at the Euratom reports and the IAEA data reports, I noticed different numbers. So I went with the more up to date source materials in those cases. Also, these reports say that the numbers they have for Russia and China are very approximate guesstimate, which could be in the actual data reports. They say that for China, it they only have a confidence of say 60% for that. So the actual real numbers could be massively different one direction or the other. All of the data for uranium is kind of shaky anyway, but you've got to realize that when it comes to the stockpiles, the reality could be quite a bit different to the publicly available data. And so this creates for the uranium market massive undercurrents, which could move the price up or down massively without you realizing, on top of what is already kind of shaky data. So that's why it's very important to attribute a very high risk factor to the price of uranium if ever you're speculating on that. You've got to accept that as well as the visible data being dodgy anyway in itself, there are these huge undercurrents totally screw things up. So you must treat it as the risk asset it deserves to be treated as. So anyway, from looking at these stockpiles, we see that the US needs to constantly be stocking up. You know, they haven't really got that much leeway. Whereas, however, Europe, Japan have actually got quite a bit of leeway, and as of course have Russia and China. So really, the overall picture you'd say is actually one of there being abundant stockpiles waiting in the background, and of course, if for example they wanted to make sure they still controlled the uranium market like they do at the moment, Russia and China could deliberately dump some of these stockpiles onto the market, into the spot market perhaps, to deliberately crash the market to help make it difficult for the US and other places to fund the investment into future mines, to help keep the situation where Kazakhstan and Kazatomprom have a kind of monopoly on the market. But then focusing down onto just individual countries, really, it's only the US and the rest of the world where they are forced to continually buy. And as you can see here, that's about half of the current reactor demand, being in a situation where they're, you know, really going to have to keep up the pace. One final thing on stockpiles is that Russia has a vast quantities of depleted uranium tails stored actually as uranium. I believe actually a lot of that's stored as uranium hexafluoride still. And the thing is, for most countries, that would just be considered nuclear waste actually, or perhaps a secondary source of supply. But in Russia's case, they have the facilities to actually process this, but rather than it being kind of a large amount that can enter the market, it is kind of restricted according to their production capacities there. But currently, about £6 million a year of uranium, of yellow cake equivalent, is being processed into fuel using this stockpile. And so that theme takes us nicely to secondary supply. And the secondary supply is currently about £22 million a year of uranium. And actually, lots of different sources say the same thing, that the amount of secondary supply is expected to drop and dwindle, and certainly isn't expected to be above £20 million for many, many years. A lot of this is because the cost of enrichment and processing of uranium has gone up because of energy costs going up, making a lot of these things less economic than they used to be. In the old days, they were still down blending nuclear warheads and as a form of secondary supply. But as you can see, that after 2013, that stopped now. Most of the secondary supply comes from tails re-enrichment, and that's exactly this depleted uranium tails that I was talking about going on in Russia. But there's also some other countries doing it as well, to the tune of 50 million pounds of uranium a year. How that works is you have the depleted uranium tails; those just get fed back into a enrichment plant and taken down to 0.1% uranium tails assay, or uranium 235 isotope tails assay. So that's how you use this depleted uranium to get some extra uranium out without having to purchase more yellow cake. Now, Russia have the kind of unique ability to be able to do this because they have specialized large scale centrifuge plants designed specifically for that. Plus, they have cheap labor and cheap energy. It's not really practical for other countries to do this much. And actually, for many years, Europe have been shipping their tails, which might be, say, 0.3%, to Russia for that purpose. So, in terms of stockpiles, like I say, in the old days, they used to downblend military grade nuclear warheads to make nuclear fuel. This is the current military stockpiles in the world of uranium and plutonium. And actually, only recently, Donald Trump's been talking about a some kind of nuclear dearmament treaty. To be honest, given that this is the all of the nuclear warheads in the world, they would only actually be processing kind of half of that, you'd think, as a worst case or best case, whichever way you look at it. And the problem is, it's not something you can do instantly. You need to build the facilities, and it will only be a limited amount each year that you'll be able to process. It's certainly there as a potential source of secondary supply, but it's probably going to take a while to kick in. You'll have some reaction time there. Once you actually see a deal signed between Putin and Trump about nuclear disarmament, then you could start perhaps investigating. You'd have a few years before it started having a serious effect. Of course, this can work both ways because we know that actually several countries are talking about becoming nuclear armed. For example, Poland and Turkey most recently. So this can work both ways. Actually, if following what's been going on in politics recently, we see nuclear armament, not nuclear disarmament, then this would actually turn into a source of demand for uranium, not a secondary supply. The depleted uranium tails, this is the worldwide stockpile, and it is saving 50 million pounds a year. The next decade, I couldn't see this picking up much. But in the future, let's say, for example, if nuclear power did take over and the price did start getting higher, then you could kind of see them perhaps, why not build a small modular nuclear reactor just for recycling depleted uranium tails? So there are scenarios where you could see this becoming something that moderates the price of uranium in the future. But to be clear, it's deemed by almost everyone I see and all the data I see that secondary supply is expected to be dwindling and kept quite low for many, many years. So you have MOX and reprocessed uranium making up between them about £5 million a year. It's a tiny amount, really, but just to explain, once you've got spent nuclear fuel that's been used for generating power, you can actually recycle and reprocess the uranium for it and feed it back into the conversion step. And also you can get plutonium from it, which can be used either for making nuclear weapons, or it can be mixed into what's called mixed oxide fuel. Actually, only 8% of reactors can use MOX, and all of these processes are really expensive at current SWU enrichment prices. So it's good to be aware of these things, but frankly, secondary supply is kind of not expected to be something of significance for quite some time. All the same, when you look at mining production versus reactor demand, you've always got to remember to deduct the secondary supply aspect as well. Okay, so now to look at conversion and enrichment. So I remember I explained already the processes of conversion and enrichment. In terms of conversion capacity, here's a pie chart showing the capacity, and here's the same for enrichment. And there's been a lot said about how Russia controls a lot of the world's enrichment capacity. Now, when I put it together in a graph like this, we see that actually I think we're fairly well covered in terms of conversion capacity. With enrichment capacity, this is measured in what's called standard work units, and there's 63 million standard work units. However, this is a normal. This is under normal conditions, and it can be expanded or can shrink depending on if you're overfeeding or underfeeding your enrichment plants. If you're running low on SWU capacity or enrichment capacity, what you can do is to get more product out of that same capacity. You can do that by adding more uranium feed, and then removing it when it's at a higher tails assay, which means that then at the end you have the same product as before, but at the cost of less energy and less enrichment capacity. But the downside being you have higher tails assay, and also that you've used up more uranium feedstock to do that. Now, what I'm going to do is I'm going to explain how I was able to convert the SWU units into equivalent million pounds of uranium, so that this capacity graph here is proportional to the equivalent amount of reactor demand, also measured in million pounds of uranium. From this paper by Neff in 2003, this paper explains how the optimal tail assay that's used is a function of the ratio of the uranium price versus the standard work unit prices of uranium enrichment. And here we've got the long-term uranium price, and you can see that the standard work unit price increased massively following the Russian invasion of Ukraine. Now, actually, this was probably more about rising energy costs in Europe than it was to do with limited enrichment capacity in the US and EU. Because in reality, Russia has been supplying Europe with enriched uranium all the way right to this day. And actually, the US was getting delivered enriched uranium off Russia all in for as long as until only August of last year, which is when the ban came into effect. You can see this on the American EIA report, where it's quite clearly detailed that a third of the US enriched material was coming from Russia. For years, everyone's been banging on about overfeeding being caused by a sudden lack of capacity to the US. But we can see that there was no need for overfeeding because the US has been getting a third of its enrichment from Russia anyway all along. And we could see that the US could quite easily gain that enrichment capacity from the UK or the EU. And so, although it's kind of tight, the free world can really meet its enrichment capacity just about. For the same token, and thinking about what's going on at the moment with the EU and Russia, if Russia was to ban the sale of enriched uranium to the EU, then possibly that could lead to some overfeeding, and that is definitely a potential bull case that you may want to speculate on. But this depends on the accuracy of my graphic here. And so let's continue explaining that. So we've established that the current optimum tails assay would be about 0.3%. Given the current differential between the uranium price and the standard work units price. As the SWU price increased following the increase in the uranium price, I calculated the ratios and found that back in 2020, the optimum tails assay would have been about 0.28%, and then at its worst in 2023, it increased to 0.32%, but then it's now worked its way back to a current number of just above 0.3%. In terms of the uranium to SWU ratio, not much has happened actually. And then we have to ask the question, if the optimum is 0.3%, why is it that the world average is 0.24% according to Grok? But it's probably right, because we know that the Russia can actually do it at 0.1%, and why is it that the EU average has been at 0.19%? Now, nobody's actually reports this, and out of all of the enrichment capacity in the world, the only segment where I saw the number reported was the EU. In the Euratom report, they clearly state that their average tail assay was 0.19%. And that's because all along, 38% of European enrichment has been coming from Russia, who we know can do 0.1%. So initially, I used the Urenco SWU calculator, which I can use to calculate how much feed quantity would be required to create a kilogram of enriched uranium product, given a particular product assay and tail assays. And so from this was how I got the current well capacity measured in million pounds of uranium oxide, assuming an average of 0.24%, which did actually align with the tail assay suggested by Urenco on their website. So that's how I was able to convert the standard work units into this form, which you can use to compare enrichment capacity with reactor demand. And then from that, I was able to then work out what would be the demand for each country at different tail assays, so that I could test out this overfeeding, underfeeding thing we've been hearing so much about. Now, I wanted to make sure this was good data, so I double checked what I've called the Urenco method, which is the data I've used, using three other methods. One was the EU method, which used the uranium feed used according to Euratom divided by the SW bought according to Euratom, which you can get from the Euratom report. And what's great is these actually told us what the tail assay was. In fact, they're the only ones to tell us. And for that, I got a uranium per 1,000 SWUs number, which was a perfect match to the number I got from the Urenco method at a very similar tails assay. So that gave me quite a lot of confidence in this Urenco method. I also used what I called the Urano method, where I took the world uranium requirement as per the World Nuclear Association data, minus secondary supply, and then I divided that by the a claim that Uranium make on their website about the total SWU units used in the world. That got me this number, which was a good match again to the Urenco method at the assumed world average tails assay. The funny thing is that when I looked at the US feed used according to the EIA website and then divided that by the numbers of standard work units bought that year, again from the EIA report, that gave a number which was kind of unexpected because it corresponded to a 0.2% tails assay. So there's something wrong with the US numbers, unless there's something going on there. But still, I got three data sets to agree with each other, so I'm fairly happy with these numbers. And from this, we can see that if Russia banned supplying enriched uranium to the EU, if they then had to resort to overfeeding to compensate for that, if the tails assay jumped from 0.2 to 0.3%, for the whole of Europe, that would actually be £22 million extra uranium feed required. If the overfeeding jumped from a 0.2% tails assay to a 0.4% tails assay, you're actually talking about £61 million. That would actually be like a 33% increase in the uranium needed to achieve the reactor demand number. So my conclusions here are that in terms of the US, this overfeeding thing was a big nothing burger in the end, because the EU is able to compensate for the relatively small amount which the US has been getting from Russia. But should there be a ban on enriched supplies to the EU, then this overfeeding narrative really could actually put a rocket on the spot price of uranium. But barring that event, when you go through the whole thing from mining to conversion, enrichment to reactor demand, though it's going to be a little bit tight this year, everything is kind of balanced out. And in the coming years, the Europe and the US are only going to be adding to their capacity. And actually, quite a lot of enrichment capacity has been announced to be coming in line in the next few years. Okay, so finally, reactor demand. And straight away, you can see that it's actually been fairly stable over the last 5 years. Now, we've got to remember here as well that nuclear plants, they refuel every 18 months, they order through the term market for deliveries years in the future. So they actually have also quite a lot of sag in their kind of demand. You know, they'll have a couple of spare blocks of fuel bundles just in case there's ever a supply disruption. So it'd always be a number of years before there's real urgency, and there's a lot of sag there in between the supply part of the chain here, which is what affects the term market and the spot market, and the actual use of that uranium. You know, there's a good few years lag there. When we look at the actual reactor demand, it has been really stable over the last 5 years. Here it is split over throughout the world, and you see it's 20% now China, about a quarter of it is US, and about a quarter of it EU and Japan. So most of the current demand is from OECD countries. We're actually a minority from red team countries. Now, on the World Nuclear Association, they've got a breakdown of the current reactor requirements. It includes required, proposed, and planned reactors. And so from that, I was able to create this nice graph. But what we see is that actually when you look at what's currently under construction and what's planned and what's proposed, we're going to actually have to wait a long time before we see a lot of this stuff coming online. And really, I mean, obviously in China, maybe it only takes them 5 to 7 years, but in the West, it takes us 10 to 20 years, frankly, to get a nuclear power station built. And all right, okay, I know there's all these small modular reactors, but let's be realistic. We're probably talking about a good 10-year lag before we see a lot of the Western stuff coming into play. And so, frankly, a lot of the new demand is in the red team countries, and frankly, we're going to have to wait until late in the 30s before you start seeing the proper ramp up. So, although, yes, there is going to be a tidal wave of demand in the future, it's still a long way off before that starts ramping up. And that again takes me back to this graph, and where again, it's not till the late 30s where we really start seeing a big disparity here. We're more likely to hit the base case demand than the high case demand, just because of how slow it is for OECD countries to get their act together and build nuclear power stations. Here they've got from the World Nuclear Association annual report 24. You can really see how despite new builds, it's still actually flat overall nuclear energy production because we've had lots of retirements in recent years. And here we see the age of the reactors, with the blue ones being the old ones. So again, yes, there's quite a lot being built, but there's going to be a few being retired as well. This does help put that into context. So that really concludes my very detailed look at the uranium price and its supply and demand dynamics. One important point is, before this most recent bull market started, only 40% of global production could be done at a cost lower than the spot price, whereas now all of the world's mining can happen at a profit. So this is one key factor that I think we should appreciate. Also, going back to these most basic of supply and demand charts, and in a way, you only have to look at this, and you almost don't have to look at anything else, because frankly, according to these, we currently have supply meeting demand for a number of years. And back in 2020, when the price started going up, yes, there was a shortfall of supply to the demand, but that's not the case now for quite a few years. And as definitely confirmed with my data compilation here, just the most basic of data kind of tells us that there's a bit of a glut for a bit, and it won't be really until the mid to late 30s before we really start to get that supply shortfall that everyone's so excited about now, a bit prematurely perhaps. Another thing is, all of the basic data is all a bit wonky, and then there's also these hidden undercurrents, particularly surrounding secondary supply and government stockpiles, where at any moment that could lead huge changes to spot market supply. And so, given the wonkiness of the general data plus those hidden undercurrents, you actually have to apply massive error bars to the data that you're using when making any kind of analysis with the uranium markets. And so that means, it could be upside, could be downside, but it means you really have to treat uranium as a high risk asset, to respect the wonkiness of the data and to respect these dangerous undercurrents. There's generally bad data around mining production and supply. When I looked at the good data, which is Cameco and Kazatomprom, there's an interesting trend of production, particularly of Kazatomprom's partners, starting to exceed the overall supply. And then when we look at the world overall supply, this is kind of a yellow flag, this data here. It kind of suggests that maybe production might be getting ahead of itself at these higher prices more than a lot of pundits are accounting for. So that's something to keep in mind. Again, to reiterate, things don't really kick off until from the mid to late 30s in terms of demand for uranium. And something else to think about is that because red team countries currently control most of the production of uranium, it's likely that the US and other blue team countries may start pushing for new mining, even if it's doing things like using contract for difference and things like this, because otherwise, how are they going to encourage people to open mines when opening those mines would drop the price? And then if that happens, we could be looking at kind of a overcapacity of mining production. So in the longer term, you can see how the mining supply will actually be able to keep up with the increasing demand, given that that won't be for another decade before it's at its apex. So in the next 5 years, if you see lots of new mining projects starting to be going ahead in places like the US and Australia, then you can kind of expect the supply to be keeping up with demand. If, however, 5 years goes ahead and you've still not seen any new projects, then actually you'd be feeling a bit more bullish in the long run. But I do think that with the current geopolitical issues going on, we could see the US government and then the Australians maybe setting up mines to supply the US, particularly in Europe, with these kind of deals with contract for difference plans and things. And if that happens, don't be too excited about future shortfalls in supply. If the Western governments finally realize that uranium is a strategic asset and start acting accordingly. And finally, although overfeeding was a big nothing burger in the end in terms of the US, one definite kind of bullish moment I could potentially see in the near future is if Russia was to ban the sale of enriched products to the EU, then this overfeeding thing could be coming back with a vengeance. And that would be very bullish for the uranium spot price in particular. So finally, this chart, I think, consolidates my findings really quite well. We had a massive bear market with the spot price dragging the long-term price lower, as shown at the back end of that with 2020. Rather than using the term market for their supplies, the utilities were just undersupplying themselves from the term market and buying spot material instead on the cheap. And at the same time, the miners were deliberately holding back production and topping up their supplies with cheap spot market volume. And you can see the back end of that perfectly in this graphic that I've put together with the minor spot purchases finally tailing off, not in 2022. The term market volume increased. Then, as we had this 4-year bull market, we're back to healthy market dynamics again. But the price has now gone up, and it does really appear like we have a bit of a match now between supply and demand. As you can see really here. Given my analysis of all this data, my base case for the price of uranium is for the long-term price to now stay fairly stable for quite some time because there's a balance between supply and demand. And I do expect the spot price should get anchored by the long-term price. However, as we went through, there are lots of hidden undercurrents in the uranium market, and there's potential that there could be stuff being dumped on the spot market from government stockpiles, even from miners. If that's starting to get out of control, there could be some mining product getting dumped on the spot market. So there are lots of various scenarios where these dangerous undercurrents could pull the uranium price down. And I think there's a good chance of something like that happening. And frankly, that's what this is starting to look like here now when we compare the long-term price with the spot price. Because previously you had a crash in the spot price, then ultimately dragging down the long-term price. And frankly, it does kind of look like the start of that now. But we won't know for like another 6 months if a repeat of this is what's happening, or if we see the spot price finally getting anchored by the long-term price. So that completes my detailed analysis of the uranium price and its supply and demand dynamics. Please remember this is for entertainment purposes only, and I hope you found it useful. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.